unmute yourself and speak up as you have a
Okay.
question. Um, the nice thing is too is that the presentation I'm going to give tonight is the one I sent out a week or so ago, and everything's always available on our website. So the only difference is you have to go to the financial advisors side of the house. We don't have a lot of the a lot of our presentations and materials are on the financial advisor side. But if you go on this side and you go to the insights tab, then the presentation which we just sent out, so the quarterly newsletter which we sent out, you just hit that, and you'll see this was the third quarter we sent out a couple of weeks ago, and then the economic presentations what I'll go through tonight, and then other your questions because I didn't even cover like the Israel uh, situation in here. The one slide that if you only remember one slide tonight, then this would probably be the best one to remember, especially those of you who haven't been with us very long. A lot of you, like Lou, and many of you have been with us for 20 years. And when I founded the company 27 years ago, our performance track record goes back not to 1997, which is actually quite good during that sell-off, but goes back to 2003. And we've been through a great deal, of course. We have been through the tech bubble, where the stock market collapsed 50%, an Iraq war, two Iraq wars. The real estate bubble burst in 2007. Financial crisis, of course, which was brutal, another 50% stock market collapse. Um, oil energy crisis and European crisis, and then of course recently COVID, where the stock market fell 30%. So it's been a rough 30 years, but we're still standing. And the green triangles, I always kind of talk about the green triangles as our way of what we do at Altruist that has always kept all of you who are retired um, staying retired and not having to go back to work, because we're always going to have periods of time where the stock market is volatile, and there'll be periods of time when you're nervous and wondering, is Pepsi going to keep paying their dividends? But we never invest in hope at Altruist, and it's what's allowed our clients over the last almost 30 years now to survive these horrific 50% stock market collapses that we had in 2000 and in 2008, and then of course having gone through COVID. So each one of these has felt terrible and very, very scary, and it certainly impacts our income in Altruist because we get paid based upon portfolio values. So when the market goes down 20-30%, we get paid a lot less. And if you fire us, and thank you for all these years where you stayed with us, I know our client retention is like greater than 98%, and we appreciate all the support and trust over all these many years. But you don't, even when the market falls 20%, your income does not. And that's critical. As long as Pepsi and Procter & Gamble and Nestle and the companies we own, the other 70 companies we own, and I own the same companies that you do. I own all of my retirement money, and money is invested side by side, all of you, 100%. I don't invest in Bitcoin or anything stupid. I don't have any play money in Tesla or crazy valued companies. I'm invested side by side you, as are all of our Altruist associates in our 401k. And I think that's important too to kind of remember. And having gone through this, as we've had, in the past, we've been able to, as you can see from the next slide, it's basically the same thing. If you're like me and you don't need the income, you're just reinvesting those dividends. And certainly $1 million invested way back in 2003 has grown tremendously, even though we've had all of these ups and downs along the way. And those of you who have taken out 4 or 5% a year, you still have more than $1 million with us. And that's kind of remarkable too. Our clients have been with us 20 years. A lot of them, I was talking to one last week, she started with 3 million with us years ago and still has 3 million today and has taken out more money has taken out like $3.2 million. So she's taken out more money than she started with us 20 something years ago. But still has 3 million. And that's a testament to the way that we manage money. So although you're going to have volatility along the way, and we're up a little bit this year, but we could just as easily be down this year. As long as the dividends and interest, as long as you're not outstripping that, then you're going to be fine. And we never have to sell a share of Nestle or Chevron or Exxon or any of the companies we own. And this provides you with the stability to fund your retirement income needs. And I think that that's critical to the way that we invest, rather than where I'm throwing it into something and hoping that it goes up higher in price. And that's what we look for. And last year, in the last year, 80% plus of our companies actually increased their dividends. And that's, and last year, of course, the market collapsed almost 20%. You and I, our portfolio values were effectively flat last year. I think we were down a fraction. And that's, again, a testament to our strategy and quality, dividends, and not paying too much for what we do. And I think that's what kept us holding up last year. And this year we participated with the rally, although we're pulling back here a little bit in October. We're never going to invest in stuff that's really high flying. As much admiration as I have for Elon Musk and Jeff Bezos at Amazon, I'm not going to pay 100 times earnings. I wouldn't expect somebody to pay 100 times earnings for my company either. And that's just the speculative mania that goes on at Wall Street. And not to mention, those companies don't pay dividends. So when a company like that is down last year, let's say it's down 60% like Facebook was, or some of the stocks that just got killed, when you're pulling money out and the market's going down, it's just devastating to your portfolio. We'll own these companies when they're cheap. We've owned Microsoft in the past and we've owned Apple. But then when they get too expensive, that's generally when we're going to sell them. And this year, we've had these companies, I call them the fat man stocks, these 7 huge mega cap tech stocks from Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla. And you could throw Netflix in there, which collapsed last year pretty badly. They make up now almost 30% of the market as a whole. And this is very reminiscent. If you go back to some of those of you who were around in the 60s will remember what was called the Nifty 50. And in that time period, every Merrill Lynch broker and every stockbroker from Morgan Stanley and the big wirehouses and brokerage houses back then were putting their clients in the Nifty 50. That was a real mistake to buy those high flying stocks, because everybody was doing it in the valuation of those companies. You can see the top 10 market cap stocks were now approaching that level again for those Nifty 50. The Nifty 50 collapsed badly. Of course, we had the 1973-74 recession. And you can see those very large stocks came down from what was 31% of the market to as low as about 19%. So on television, my former neighbor there, Jim Cramer in Summit, New Jersey, and many others are going to get on and say, this is what you got to buy. This is what works. Well, last year that all collapsed. This year it seems to be working, but it could just collapse again. And you don't want to chase and pay too much for anything. And we don't. Even when I founded the company in 1997, everybody wanted these huge tech stocks. And we had this huge run up during that period of time. Well, we didn't buy it. One of the reasons why we were only down 12% or so in 2000, when the market went down 50%, you can see that collapse. We're well beyond that. Of that tech bubble that burst, those so-called Magnificent Seven, or what I call the fat man stocks, are much higher from a valuation standpoint than they were during the tech bubble and that 50% collapse. So we don't want to go near those companies. And part of our discipline is just simply not chasing what the herd mentality is doing, because that's when you can blow up your portfolios. Instead, our focus, again, if you remember one slide, our focus is always on quality companies, sell for reasonable valuations, and pay you and I a dividend. And You can use that dividend to fund your retirements. Right now, the portfolio is paying right at about 4.5, 4.6%. So we're getting nice dividends from the portfolio. And of course, the S&P 500 is paying like 1.6 or 1.7%. This year, that has worked, right? The Magnificent Seven here, or the fat man stocks, have just gone off to the races this year after just getting obliterated last year. We're starting to see them kind of come down here now, float a bit more. But again, we're never going to chase that. Whereas the overall market and the broader market is flat to now down a little bit on the year. If you take out those 7 stocks, the broader market hasn't done very well. And you can kind of see that from this slide, is that the percent of stocks that are outperforming the S&P 500 is very, very low. Again, because it's just being driven by those few stocks. Now, chasing performance has never been a good, this slide is very telling. Go back to 1980, you probably forget that AT&T was the second largest company in the United States. IBM was number 1 back in 1980. And then all of the oil companies, Exxon, Standard Oil, Schlumberger, Shell, Mobil, those were all the largest companies. They all came back, dramatically from those heights. Same thing happened in 1999 when Microsoft and General Electric, anybody remember a company called America Online or Lucent Technologies? Some of these companies are gone. They don't exist anymore. And, they were the largest companies that everybody was raving about at the time. Cisco, which we own today, after it imploded, we purchased it. Cisco has still not reached its high watermark that it hit back in 2000, which is remarkable to think about. Here you are 23 years later. If you purchase Cisco at the high, you're still not back to 23 years later, still not back to your initial portfolio value. So what's going to happen? What's going to happen to these companies? Is Facebook going to be here? I don't know. I'm pretty sure that you and I will still be drinking Pepsi or eating Nestle chocolate or using, I didn't shave today, but using Gillette razors from Procter & Gamble. But I don't know if NVIDIA is going to be around. I'm not sure if Amazon, something else may come along to outstrip Amazon. If I was a betting man and I'm looking at another 20 years and we're sitting here in 2040, we're going to have probably 4 companies in here that we've never even heard of. And if these companies are still here, they may not be the largest market capitalization companies in the United States anymore. So just something to think about when, one, making sure that we're diversified and you have a portfolio of a lot of companies like we own, 70 different companies, because owning the largest company in America has lagged the market badly. If you go all the way back to 1973, it's never been a good strategy to buy the biggest and most expensive stuff. So again, part of our discipline is not to chase performance. Now, a lot of you concerned about what's going to happen. And my answer is I'm always in the I don't know camp in the short term. So somebody will say, Jim, what do you think the market's going to do this week? What do you think the market's going to do this month, this quarter, into next year? My answer is always, I give the Polish salute because I'm half Polish. I just kind of throw my hands up and go, I don't know. What we do is scenario analysis. We look at the worst case analysis. So what if all the bears are right? Now this year, I think I was probably the only economist on the planet who predicted 5% treasuries and the Fed was going to have to raise rates and inflation would be sticky and that we weren't going to head into a recession this year. If we go into a recession, I thought it'd be next year. Most market quote unquote experts were predicting a recession this year and expecting the Fed to actually lower rates. So we model for that. We say, okay, what if the doomsayers are right? And the doomsayers come out every time the market goes down 1% or 2% in a day. CNBC and Bloomberg trot them out. And if they're right, the market's going to lose money. You and I are going to lose money over the next 5 years. Now, this is a 5-year, and I'm using the broader market averages when we do this. I'm not using our companies. Our companies are selling at 11 times earnings. They're quite cheap. And paying you a nice 4% plus dividend. So we'll survive this because we're buying cheaper companies, whereas this is looking at the broader market as a whole. Now, maybe the bulls are right. There are a few bulls left. Maybe the stock market is just off to the races and we make 9 or 10% a year from stocks. The truth is probably somewhere in the middle here for our base case scenario, that we can make, mid to high single digit returns. The good news is that at least we're not at 0% returns for bonds anymore. Our high yield bonds are making us, 6, 7%. And our treasuries are yielding us, 5.4% right now for short-term treasuries. So that's a really nice rate of return that we're able to get for our bond portfolio. And I think that's critical and nice that we're able to at least get a rate of return, which we haven't been able to do for 13, 14 years since the financial crisis, and 0% interest rates. Now, what caused this issue is, as Milton Friedman would say, the great economist. And if you're a geek like me and you enjoy reading economics or want to watch a good on Amazon, you can get Freedom to Choose. And it's great videos of Milton Friedman back in the 70s. So nothing is new, right? If you look at this debate going back between the socialists and the capitalists, you can go back to the 70s when, Italy was on the verge of communism. And America was certainly fighting these forces of capitalism versus socialism. And Milton Friedman defends capitalism at its best. If you watch Freedom to Choose, it's a great series on Amazon.com that you can get it. And but Milton Friedman always says that inflation is always and everywhere a monetary phenomenon. And what he meant is persistent inflation too. And when the Fed was printing money as aggressively as they were, and you can see the money supply here, the green triangle, well, the consumer price index, which is inflation, always follows the Fed. Or that you can see the green line going up, usually the brown line, the CPI is usually following that. You'll remember that in the 80s, of course, we had hyperinflation. And that's what happened here. The Fed was inflating the economy, and the CPI did that. Now the Fed's starting to reduce interest rates. You're seeing the consumer price index come down. It's not down, however, at a level that's comfortable yet. It's at the Fed's target's at 2% as a target. So they may have paused. If I was a Fed chairman, though, I would continue to increase interest rates right now, because the Fed's job is twofold. One is full employment, which we have, and two is, make sure that we don't make the mistakes that we made in the late 60s and 70s, where the Federal Reserve left interest rates too low, and that caused hyperinflation in the 70s. So the Fed's watching this, and you can see the good news is since we're not all locked down in our houses anymore, the goods is coming down, but services, because everybody's out, right? I was flying last night, and planes are packed. They're full to the gills. People are traveling, and they're still spending money, and that's the good news for the economy. But that's the bad news for inflation, and especially inflation when it comes to services, which you'll see in this slide. If you see the green line is goods, and see how goods is now finally kind of come down, even a little bit negative. So that's like guns and butter and coffee, which I'm drinking here. And whereas services is this darker brown line, you can see how services is still very sticky and very high. People are still, traveling and visiting places and staying in hotels and paying for those services. So that's keeping inflation high. So what you're seeing from the U.S. wage growth too, and inflation, I was team transitory too here back in the fall of 2020. I thought, well, inflation will come back down because it's not in wages. As soon as I saw it in wages, this is where I was screaming at the Fed and friends who work at the Fed saying, what are you doing? What are you doing? It's clearly in wages. And here it came, right? Once it's in wages, it's in the economy. People have more money from their jobs, and they're going to spend more money. And the Fed was still printing money incredibly. And then finally in 2022 of March finally started to raise interest rates way late. So they, again, inflation is always and everywhere a monetary phenomenon. They kept it way too high, and that caused inflation to be and to stay in a sticky regime. And it's tough to get inflation. It's not as hard. Disinflation is the old Keynesian pushing on a string, right? I could throw all the money in the world on a table. When everybody's scared, nobody's going to borrow it, and businesses are not going to invest and build factories and invest in their companies because they're nervous, and banks aren't going to lend it because they don't want people to go bankrupt on their loans. So it's tougher to get the economy stirred up, even going to zero and even printing money, than it is when you have inflation. It's easier to bust inflation by just raising interest rates until finally people say, I'm not going to buy a house. I'm not going to get a loan and buy a boat. I'm not going to go out and buy a new car because interest rates are too high. And that breaks inflation eventually. Much easier for economists to fight inflation than it is to fight disinflation. The good news about inflation is that expectations, unlike we saw in the early 80s, late 70s, inflation expectations, longer term, the green line here, still remains relatively low. So people don't expect inflation to go up 10%, whereas shorter term, people are very nervous about inflation. So that gives the Fed some leeway. And the real interest rate is finally starting to come down. You can see it popping back up again because inflation, again, was peaking up the last quarter. And the Fed's got to get ahead of that. They were ahead of it a little bit when inflation started coming down. But again, if I'm the Fed chairman here in November, I would be raising interest rates again because you don't want the market to see the real interest rate to get high. Now, I'm not paid to manage money based upon what I think the Fed should do. I'm paid in managing the short end of your curve in terms of what the Fed will do. And if you look at the futures right now, the market is telling the Fed, hey, you're not going to be cutting rates. See this? There's a 99.7% chance that the Fed is staying right where they are at the current interest rate. They are not going to be raising interest rates because that would shock the market. So they should, in my opinion, be raising. But the market is, and this was just like 80% just a week or so ago. You can kind of see that here. It was 72% back in September, 88% in October. So in my opinion, they should, but they're not going to do that. Now, December is a different story. 75% chance that the Fed's going to be staying put because they're kind of seeing this thing work out. They might think, hey, this is an anomaly that happened here last month when we saw these inflation data high again, that this real interest rate is a fake out. So we're going to hold where we're at. I think it's a bad decision. The Fed has an abysmal track record over the last few years of raising interest rates when they shouldn't be and holding low. And again, I screamed when they were raising rates and shouldn't have been, and been screaming all the while that they've been missing it. And now they're trying to catch up. And the reason that they don't have to and they need to raise interest rates is look how strong the job market is. There aren't, as there were last quarter, there aren't 2 job seekers for every 1 job opening anymore. But there still are a lot more job openings than there are job seekers, which you can see. The brown line is the unemployed people. And then the openings is the green line, which has come down because businesses are starting to lay people off, specifically in the tech sector and in our sector, in our industry, in the finance sector. We're seeing people getting laid off a lot. Goldman Sachs laying people off, the larger banks, Citigroup, Bank of America laying people off. And a lot of people have left the job market. So this is an argument for immigration, in which this country was founded on, that we need more people to come in, work hard, support our economy. Of course, we got to do it in the right way, but we need to fill that gap. But that gap right now will keep wages higher, because if I'm employing new people, which I am, just 2 people this year I've hired, I'm looking at hiring another person, I've got to pay them more to incentivize them, because I'm competing against other people to come in and get that job. Whereas if you have, less openings than people who are looking for openings, then you're going to pay those people less. The unemployment rate remains very low, which is a positive thing. Our government debt is very high. I'm not going to get off on the government debt issue. If you want to read my blog, or I talk about Is America Going Broke, which I wrote 4 years ago, maybe 6 years ago. And this is not a Democrat Republican thing. A lot of times people blame Democrats or Republicans. I'm an equal opportunity basher. I don't have a party. I always say my party died with Hamilton. I'm a Federalist, so I don't have a party anymore. So I'm able to call balls and strikes pretty well on Democrats. And you can kind of see in the 50s here, of course, we had Eisenhower bringing down the debt. Kennedy, probably the last Democrat. The Kennedy Democrats are dead and gone. Responsible Democrats who were managing and reducing taxes, and then also managing the debt. Then, of course, we had Nixon, and then the Carter years. Nobody wants the Carter years anymore. We're at the Naval Academy, or we're naming a building after him, because we're replacing one of the Confederate admirals who with that name of a building to the Carter building. But nobody wants the Carter years anymore, where we only had 30% debt to GDP, and of course Reagan exploded the debt to kind of fight off the Soviet empire. Bush kept pushing it up. And then during the Clinton years, we actually brought it down a little bit, because we had the huge tech bubble, which helped. And then after Clinton, we had Bush, who increased the debt a little bit. Obama exploded the debt during the financial crisis. And then Trump exploded it even more, particularly with COVID. And then during the Biden administration, it's come down a little bit, but still 120%, right? More than it was during World War II. Is that sustainable? Japan's been a 200% plus debt GDP for decades upon decades. As a capitalist, I don't care. As a patriot, I care about these issues. America's still the strongest debt in the world from an interest rate standpoint. So I don't think we're going broke. Even our congressmen can't screw that up in the short term. Longer term, they can. Entitlements is certainly an issue that has to be eventually addressed, especially from a competitive standpoint. But the companies we buy, it's like, think of it in terms of a young doctor who's making $500,000 a year. If you're working for Truist Bank, you'd be happy to lend that doctor $1.5 million to buy his new home. And that's a 300% debt to income that he has. Now, if it was a balloon mortgage, like our debt is it comes due, let's say, every 5 years, and Truist Bank or Bank of America or Wells Fargo said to that doctor, "Hey, doctor, give us the $1.5 million." The young doctor would say, "Well, I've got $400,000 in medical debt. I've got a house payment. I've got 2 cars. I don't have that money, but I'm making $500,000 a year. I can keep paying my debt." Well, America can keep paying the interest on its debt. And as the companies that you and I own, whether it's Goodyear Tire or any of the bonds that we own, those companies have good cash flow. They couldn't pay back all their debt, but they can pay the interest on that debt. And the question for America is, when does it start to hurt too much? And when do we have to start cutting back American? But that's more of a political question. Don't worry about that. I know when you turn on Fox News, you'll hear about this kind of stuff and people freak out, and I get the questions, but from a capitalist standpoint, this has no impact on how many Pepsis are consumed in India, how much Nestle chocolate is consumed in Latin America. I said this once on my blog when I said, "Is America going broke?" And Senator Young, who's a friend of mine, Republican senator from Indiana, he sent me a text. He said, "What do you mean I don't matter?" Because I said, it doesn't matter whether he gets elected or not in Indiana. So I like him and I support him, but it doesn't matter, right? It doesn't have any impact on how much Pepsi is consumed, if Todd was elected or not in Indiana. Personal consumption is really strong right now. if you make money, you spend it, right? And people are making money right now. You can kind of see that with the brown line. As people get paid, the green line follows it. The recession that we had during COVID was the only recession in history where people were making less money, which you can kind of see, and weren't able to spend it because consumption was actually going down because we were all stuck in our homes and they were getting paid to stay at home. So you see that brown line going up tremendously, right, during COVID, but then it came down. And that was one of the only times in history where we had a recession and personal income was going up. Because usually during recessions, people lose their jobs and personal income goes down. But right now, the American consumer is not dead. He's out there. I mean, you go out in your towns that you live in, and you'll see people out in restaurants spending money, which is obviously expensive. It's a lot more expensive than it was 3 years ago, yet people are doing it. I got a sandwich and a cup of coffee at Starbucks today. It cost me $7 or $8 with a tip, I think, maybe $8 or $9. Did I need to spend that? No. Did I? Yeah. And people are doing it. They're spending money out. We know what you're spending. We see the millions upon millions going out of our clients' accounts. You're spending money, which shows your confidence. And consumption goes with income. And the good thing with Altruis is we're providing the income, right? We're providing that 4.5% to you to go out there and spend it. Now, the bad news for the American consumer is that he's just about tapped out. He's gone through all of his savings from COVID, where it's just piling up and piling up. And then when COVID collapsed, unlike Montana, where COVID never happened, people are out. there was no going back and forth every 10 days between Montana and New York City was fascinating. It was like people masked up outdoors in New York, petrified, everybody in their homes, nobody out, ghost town, to Montana, where it's like everybody out, no big deal. And it was a fascinating two very different economies. But most people were holed up and not able to spend any money, and now they've spent it all. Now they're back to the savings rate, to very low. Americans don't save money, right? We're not like the Japanese. We basically spend everything we have. It's part of our national pastime, right? That's why we have malls here. People go out and spend money. And if you go back to the 60s, people saved a lot more money, right? And even the 70s, people saved a lot more money. Today, they don't save as much. And they live paycheck to paycheck. But now they're tapped out. And they're not quite as low as they were, but they're pretty close. So they can't, now they're starting to spend on their credit cards. So if you look at like Bank of America estimates, you'll see that people are out absolutely starting to spend money on their credit cards. The other thing is cars last forever. And I'm still driving, although my son Maximus has the car now, almost 300,000 miles. It's a 2000 Land Cruiser, 23 years old, older than all my kids, except for one. One of my 4 kids is older than that car by 1 year. Still running. People still put notes on that car saying, if you ever got to get rid of this car, call me and sell it. And cars last a long time today. They're built to last. Nobody needs a new car. Now, I know that you call me and you call Chris and you call Harrison and you call Greg and you call Max and you say, I need a new car. Nobody needs a new car. Really, what you should be saying is, I want a new car. And there's nothing wrong with that, right? That's why we have this money. We can't take it with us. But when I look at auto sales, which is this brown line, people are out buying new cars. And that's one of the highest, and cars are a fortune. I was like, I got a Ford F-150, and we have a little Subaru, which I paid $26,000 for in Montana that Annie drives. Works great. Probably work great another 10 or 15 years. And same thing with my Ford truck. But if I were to buy a new Ford truck now, it probably costs $50,000. It's a fortune. And yet people are still buying new cars. Now, home sales have come down because we have much higher mortgage rates. So the affordability of homes has skyrocketed. Yet inventories are low. So home prices have not collapsed. Home prices are holding up well. home sales are holding up okay from a historical standpoint. They're not as high as they were, say, in 2005 when I was literally calling for the bubble here. I had realtors calling my radio show back in North Carolina saying, "You don't know what you're talking about. Real estate always goes up on the coast." And I said, "No, read my book, The Ritz-Carlton Rule. If you could stay in a Ritz-Carlton for the price of your $1 million home, where you're paying $60,000 a year, $80,000 a year, and you're not using it more than 4 or 5 months, you can stay at a Ritz-Carlton, do the math, for $800 a night, $60,000 a year mortgage divided by 800 a night, that gives me 75 nights that I can stay in the Ritz-Carlton for the same price." So like anything, you don't want to pay too much. We're very disciplined. We're not going to pay too much for stocks. Same thing for real estate. You don't want to pay too much for real estate. If you can't rent the property for more than you're buying it for, you shouldn't buy that property. Now, we need homes to stay in, but that's a separate matter. The other good news is that corporate profits are very, very high. So companies are doing a terrific job by laying people off in some instances and using productivity and using technology to keep profit margins high. This is very, very good news for you and I, that dividends will be maintained and probably continue to grow. So from an investment standpoint, again, we're not going to pay, we've had this growth stock run for these very high priced fat man stocks, which has been, and I kind of always tease my team a lot. Most of us, other than me and Rita, really weren't even around, right, prior to 2005. And all of these guys who came into the business, a lot of analysts and MBAs and Harvard grads, this is all they know, is to buy these high overpriced stocks. This is a higher bubble than it was in 2000 when this thing burst and the NASDAQ went down almost 80%. We're not going to touch those stocks. I want to be here the next 30 years still managing money. And the last thing I want to do is blow up my company and blow up your life savings by paying too much for speculative companies. We're going to buy boring companies that pay dividends, selling at reasonable prices. Now, last year, the reason why we weren't down 20% and we were flat is because we avoided those companies, and you can see value made a comeback. But then this year, again, growth has kind of been leading again. What's it going to be next year? Who knows? But I know that we're not going to buy those companies. We're going to avoid those. Same thing with international. The S&P 500 U.S. stocks have broadly outpaced international stocks. Now, your portfolio and my portfolio is basically 50-50, international and U.S., because for the first time in my almost 30-year career, international stocks look so compelling. And this is usually long-term trends. So you can see for a long time here, international stocks outperformed, and now for a long time since 2014, U.S. stocks have roundly outperformed. That stopped last quarter. And then this year, again, U.S. stocks are outpacing international again, although that's not the case for us. As of yesterday, I think our international stocks were up 8% and our U.S. stocks were down a little bit. And you can see, by the way, DivD is our ETF that we sell to financial advisors around the country. So a lot of times people get confused. They're like, wait a minute, that email we just sent out saying in our first year, these are the same stocks that you and I own in our portfolios, but we own the individual stocks, which allows us to be a bit more tax efficient and allows us to direct the income a little bit more. And you can see DivD's up 1.5%. That's basically what you and I are up year to date. Most of the returns are coming from international stocks this year. And our trailing year at the end of the quarter, you can see trailing year, we were up 24%. Most of which came all in the last quarter of last year. And, and value was doing very well and outperforming. So you can kind of track, and this is the ETF that will put, your kids and grandkids in when they don't have hundreds of thousands of dollars, but want to invest in our same type of process and philosophy. So it's kind of nice to be able to see at least how our, because most financial advisors just chuck their clients in funds. 98% of our competitors do that. They're not asset managers like us. We have wealth managers. So Harrison and Greg and Chris and Max are doing the wealth management with you. how much should you put away for your retirement? How much income can you take out? Well, what type of life insurance do you need? Or should you have long-term care? Should you pay off your home? Should you buy or lease a car? Uh, Interfacing with your accountant, estate planning, all of the things that impact your wealth management business. That's where we're like our competitors. Where we're different from our competitors is we're an asset management firm too. We have published performance, and we sell our services to those financial advisors all across and wealth management firms all across the country. And again, international stocks are very cheap compared to US stocks, which is why we like international right now. And if the dollar weakens, that's actually good for us as Americans own international stocks like Nestle and British Petroleum and GlaxoSmithKline and other foreign assets. Treasury yields have finally come off of zero, so now it's nice to be able to get a 5% return. This is not abnormal. People are acting as if this is horrible, and the market has not sold off for geopolitical reasons. Let me talk about the geopolitical side now, I guess. There's been a lot of concern. We're heading into a presidential election year and, a lot of congressional races. And there'll be a lot of nervousness about Republicans or Democrats. And again, as patriots, you should care about these things. As capitalists, it doesn't much matter. There'll probably still be gridlock. It's highly unlikely we have one party rule next year. The Senate races look pretty tough, even in Montana, where John Tester, who almost always votes with the Democratic Party and does not represent the values of Montana, he continues to win out there, and he may lose his seat. But even if he loses his seat, the Democrats may still hold the Senate. Republicans, if Trump is the nominee and Trump happens to beat Biden, then maybe the Republicans pick up some more seats in the House. We'll still likely have gridlock. And the elections people are nervous about it, but the elections are likely to have little impact on the market. In the short term, we may have some variability. Of course, the Russian-Ukraine war has caused issues more with energy. But as we've seen, we've gotten, unfortunately, used to that. The horror that happened in Israel, it's terrible for the Palestinian people who are not Hamas backers. Obviously, they're trapped in a couple of ways. And the atrocities are horrific from a human side. But it's unlikely, it's possible that it expand. But it's not probable that Iran gets involved. It's not probable that we have a global world war, which is immediately what you hear, right? My one son who's, in ROTC, is like, I'm going off to war. I'm like, well, first of all, you're a freshman, so you won't be going off to war. And second of all, that war will probably be over. So calm down. He wants to be a Marine because he's dumb like his father. I keep telling him to go in the Air Force, fly in the Air Force, especially because he's 6'5". And I don't want to see my son go off in the military, because you worry about your kids. But I'm proud of him for wanting to serve his country. And but the likelihood of him going off to war for that type of battle, it's likely to be a very regional conflict. Iran does not want to get involved in a broader war. They'll fight a proxy war. They will fund Hezbollah, will fund Hamas, and Israel will be fighting for its life like it always has for 80 years. But the impact that has on how many Pepsis are consumed in India, how much Nestle chocolate is consumed in Latin America, probably very little. That's ultimately the question you want to come back to. What has been driving the market volatility recently is not the geopolitical, it's this. It's the 10-year treasury finally getting up to 5%. So you see it pop up to 5% and the market starts selling off. Oh my God. Why? We've had above 5% yields forever. It's just these kids, and I make fun of the 20-year-olds and 30-year-olds who are just brand new, right? Coming out of newly minted, are like, oh, I can't buy NVIDIA because the market's down and there's not. Who cares? It's okay to have 6-7% mortgages. It's okay to have 5% treasury. In fact, it's wonderful because now you who are retired at least get a little bit of return if we can keep inflation down at 2%, right? And you're yielding 5%, or better yet, if you own our high yield bonds and you're owning 6%, 7% high yield bonds, then we're getting a much better return than inflation. Whereas if you have higher inflation and you're getting 5% and inflation's 4, your return after taxes and after inflation is effectively 0. And that's why we do have to take some risk, and that's why we invest in stocks, because not only are you getting that 4.5% dividend, but you're getting potential growth for price appreciation over long periods of time. I have no idea what the stock market's going to do this week, next month, next quarter, next year for that matter, and don't care. I care much more about the longer term of what stocks are going to do and their prices. Just like I wouldn't buy my company. I wouldn't buy a chocolate shop here in Michigan and pay 5 times earnings for that chocolate shop. Let's say the chocolate shop's making $100,000. Well, I wouldn't pay $500,000 for that chocolate shop and then sell it just because it's worth $400,000 a year from now. I'm buying it for the next 5, 10, 20 years rather than, and I'm going to collect my salary, which is our dividends, but it's okay that the 10-year treasury is approaching 5%. That's very much along historical lines. So don't get too nervous about that when the market sells off just because treasury yields are at 5%. Now, this has been an epic sell-off in bonds last year. Even our bond portfolio was down last year, about 8%. And our portfolio, and that was one of the reasons why we were actually, down like 2% last year, was because of our bond portfolio. Unfortunately, we only had about 25% in bonds last year because I was worried about rising interest rates. High yield bonds are generally not as interest rate sensitive, whereas the Barclays Ag just got destroyed, as you can see. People who are buying, and that's how those banks blew up, right? That's how Silicon Valley Bank blew up. They were buying 5-year, 6-year bonds, trying to make a little bit of extra money and on their savings accounts and paying you 0, and that just blew up their portfolios, which I wrote about when they went too long. So we are generally always staying between 2 to 4 years in our duration for our high yield bonds, and for the cash accounts that we manage for you, that we're getting you those 5.4% yields. We're buying 1 to 3 month treasuries for you in those accounts. Again, managing short-term cash risk. We don't want to go out a year because rates could be even higher, and we want to stay very short-term. And that's how we're positioning portfolios right now. As I mentioned, we're basically 50-50 U.S. stocks and international stocks, and the remainder is in bonds. But this is always based upon your personal risk tolerance. So some clients might be a little bit less risk sensitive and you're still going on the same stocks, but maybe you own 0.6% of Pepsi rather than owning 1% of Pepsi. It's good not to chase yield, though. For those who have chased yield, it's generally a big mistake to do so. We've never done that historically. As you can see, all these sectors like real estate, over the last decade, real estate's only made 56% for REITs. MLPs, which are energy, Chris made a good comment. He said people buy MLPs, they buy it for the 8% yield, but then the prices go down 10%. And that's exactly right with MLPs. And you can see we've avoided MLPs for over a decade. We've had a 0% allocation. We have bought REITs when we think they're cheap. We bought Welltower during the COVID because people still had to go in for operations like I did on my foot. We've recently bought Boston Properties, which is Class A real estate in New York City and Boston and Washington, D.C., because that stock went down 50%. We think that's a pretty good buy. But for the most part, we've completely avoided real estate over the last decade. Business development corps, utilities. Even though we have a dividend bias, an income bias, we've fortunately not owned any utilities. That would be, your Duke Energies or those types of companies. Staples we love, but we only buy staples when they're cheap. Those are the Nestle's and Procter & Gamble's and Pepsi's. And actually, one of the slides that, again, if you kind of go to our you'd have to go to our strategies, which we again sell to financial advisors, and you looked at our presentation. One of the slides I love showing financial advisors is our long-term investment in Pepsi. And if you look at Pepsi right here, over the 20 years which we've owned it. And it was actually a Naval Academy grad who was the CEO back in the day. And I actually wrote him a note. He's a 1970 something grad. I said, hey, thanks for taking care of our shareholders. And he wrote me a note back. He's like, oh, New Bern. This is when I was living in New Bern, North Carolina. I said, New Bern, North Carolina, the home of Pepsi. And it was nice of him to write me. Never thought the CEO of Pepsi would write me back. And it wasn't a mistake that he had Indri Nori, who was the CFO at the time, become the CEO. And she did a wonderful job over her term. Because the growth potential for Pepsi was in India for Fritos, right? You could rename Pepsi Fritos too, because it's really a 50-50 company. But you and I have owned Pepsi forever. And it's been a great stock for us. And it's gone through some significant bumps. And I never make moral judgments on companies. You shouldn't be drinking that crap. I mean, it's terrible for you, right? It's just sugar water and Fritos. You shouldn't eat this stuff. It's just terrible. And I know I could hear Chris in my ear saying everything in moderation is okay. And I go, no, Chris, some things in moderation are not good. Like crack. Crack is never good in moderation. Adultery, not that good in moderation. I have a joke that Annie hates. I say, I don't drink very often. I have a glass of wine. I don't smoke. And Annie doesn't let me have a girlfriend. She hates that joke. But some things in moderation are not good. And Fritos in moderation, also not good for you. I try to avoid them as much as I love them. That being said, I'm never going to put a moral judgment on any company. We're managing the profits. If you blacklist a company because you don't want to own it for some reason, then we won't own it in your portfolio. Let's say it's tobacco, right, which we own. Some religions, alcohol is evil, and we'll blacklist it. Some religions, it's fine. That's completely up to you. But I'm never going to make a moral judgment on a company. If you read my blog I talk about the Lorax, and I was cutting down trees, and it's an evil story from Dr. Seuss, the evil of capitalism, right? Well, of course, if you cut all the trees down, then you don't have anything to sell anymore. It's never good, companies we own, like an international paper, to cut down all the trees and not reforest. So in the short term, it might be good for profits, but your company's not going to last very long. It's kind of like being unethical, right? I might make more profits if I'm unethical in the short term, but you're not going to trust me. You're not going to trust our firm to do what's right for you if we don't tell you the truth. So I think that's always important. And companies need to do the same thing. And they have moral outages as they go. But a company's job is to make a profit. That's what capitalism is. It's not perfect. And my Catholic priest friends, and though I was close to being a Catholic priest, hate when I say this too. Capitalism is the holiest of all isms. It is not perfect, but it is brought more people out of poverty. And the poverty rate was, 80, 90% back in the 1800s. And today it's 6, 7, 8% or so. It's a remarkable mechanism to get people to be better off. And look at how the world has changed through ingenuity and technological innovation. It's remarkable what capitalism has done in terms of improving our lives, keeping us living longer and better and healthier. And Pepsi has certainly done that. And look at how Pepsi's increased its dividend. This is the annual income. So if you invested $100 with Pepsi, it's nice that the price has gone up to 500 or something, whatever it's at today. But more importantly, back in 2002, when it was paying out $1, it's continued to increase all the way up to paying out more than $4 today. And my son will ask an interesting question. He'll say, Dad, wait a minute. He said, how can Pepsi, if the stock is down 20%, how can they pay your clients a dividend? I'll say, that's a good question, Maximus. So here's Pepsi earning $6 a share, right? Now, if their earnings, as you can see, they're paying out $4.83. And that's a 3% dividend yield. Let's say their earnings get killed. Let's say people are on Ozempic and they're not wanting to eat as many Fritos anymore. Maybe they only earn $4 or $5 a share. Maybe their earnings get cut by 10%. They go down by 60 cents. They still have enough money to pay out that $4.83. Now, most analysts, the really smart guys on Wall Street, there's 18 of them covered, expect that Pepsi's going to make between $7.52 on the low estimate to $7.89. That's a pretty tight estimate, unlike tech companies where who knows, right? A lot of these, the earnings can go all over the map. People who drink Pepsi are probably going to continue to drink Pepsi. But let's say they don't. Let's say their earnings get cut down to $5. It's just abysmal. The stock price might go down from 162 down to $120, and everybody would get scared seeing their portfolio values go down. But Pepsi still has the earnings to pay out their dividends, and that is what you could see in that slide, where Pepsi has just continued to pay that dividend over time. And I think that's really telling for the way that we manage money. So from our strategy, again, it's always focused on getting you real income. You could throw your money in a Vanguard balance and get 2% a year and hope that it goes up. But with us, you're not investing in hope. You're getting that big fat 4.5% dividend yield to fund your retirements, and hopefully price appreciation, where we make that 6, 7, 8% a year over longer periods of time. That remains our strategy. It's the same for our fixed income strategy. You know, core bonds are at least yielding 5% now, but our bond portfolio that you and I own, all the bonds that we own, is paying about 8%. We'll have some defaults, so maybe we don't make 8%, maybe we make 6 or 7, you know, along the way. But we're getting a better return on our high yield junk bonds than we are from core bonds. And our stock portfolio, again, very cheap. Look at our U.S. companies selling at 13 times earnings versus the S&P, which is selling at 20 times. The historical average is 15. That's pricey, driven by those fat man stocks. And we're getting more than double the dividend that the S&P 500 is. And we've always done that for the past 25 years. This is what we focused on, is dividends to our clients. Same thing with our international stocks, really nice big fat dividend, even cheaper than the US market, which is why we're 50-50 right now for the first time in my 27-year career. So we think international stocks have a very compelling argument to make. So with that, I'm right at an hour, so I'm going to open it up for questions that you may have. Tried to keep it to about an hour here, so I think you can just unmute yourself, and I don't know how to mute you guys here. Harrison, are you able to unmute yourself right now?
Yes, I am.
Okay, great. So if you just click where's the mute button on yours, Harrison? Where you have to click to unmute yourself for questions?
Phone button. It should be right next to where you see the camera. You'll see 2 icons. All you'll have to do is just click on the microphone.
Yeah, so click on the microphone thing. It's up in the top right, or it should be probably right up there. This little mic button here, or you can send me a chat if you want to just send out your question. You could just type in a question here and just say just say whatever you like right here, and that'll go out to everybody. You can even just send it to me if you want to hide it. No such thing as a dumb question. And I know that you have a lot out there. I think I solved all the world's problems tonight and covered everything that might be on your mind and you're thinking about, but probably not. There's probably other good questions out there. So fire away if you have any. No questions? Or people don't know how to unmute themselves here. Let's see if I go to... No questions.
Jim, I'll break the ice just to give you something to work with. It's Smitty. How you doing, man?
Hey, Smitty. Good to hear from you. Thanks for joining tonight.
Yeah, you bet. Hey, from your perspective, the Schwab acquisition of TD Ameritrade and all of that transition, you want to just comment on that and how it's gone for us?
Yeah, a mess is how I'd say. I think, well, I guess the good news is that Assets transferred over okay from TD Ameritrade to Schwab. They had 3 years to get ready for it. So nothing was lost in the transition between TD Ameritrade and Schwab. From a service perspective, Schwab was always very, very good, but getting the TD people on board has been, I think, difficult for Schwab. And there's a lot, they're learning a lot, the new TD people. So things that we used to be able to do for you and our clients on a service standpoint, Schwab does not allow, which has pushed a lot more work on you and caused a lot of frustration for clients and a lot of frustration for us, because Rita and Claudia and Joy, they're on the phone for an hour on hold sometimes to get the simplest of things done. So they're working through some of these issues. They're hearing the feedback, the negative feedback, and they're trying to fix some of the things that people used to be able to do at TD that they can't do at Schwab. But the good news from our standpoint is that even if you're having trouble, I never look at I'm looking at the Schwab from a broader standpoint, but our e-money, so your financial planning software that you have, if you're not using our e-money suite, you want to use that, because that went seamlessly. So our quarterly reports that we send out to you that you just got, showing that, hey, you're up 4.5% year to date or whatever it was, that money is just, that's come right in. So these assets, so this is my own personal, here's Jim and Annie, right, in our assets, and I don't know what the company's worth, but I can track everything. I can track my kids' 529 plans on here. I track my PNC, Michigan house I own outright. I still got a mortgage on the Montana cabin that I'm looking to sell. These assets are, and now this is our $20,000 a year system that gives you an idea, okay, we look at it and you'll see that I own the same stocks and bonds that you do, right, in our Altruist profit sharing plan too. So today we were up 0.4%. Now your portfolio might be up a little bit more than mine or a little bit less, but for the most part, we're all in the same together. And I think that this has worked very seamlessly, and this is our $20,000 a year system. It gives you a general idea. It's not the $180,000 a year system that sends out those quarterly reports that captures every dividend and interest. But this is where you can get in and say, hey, I want to retire at this age. I want to do this or that and mess with your goals. And it's a great system, and that's flowing through. So if you're still having trouble or not liking the Schwab system, then e-money is a lot better, and I would use that, which we had when we were at TD, and so from that perspective, at least nothing was lost in the translation. But so far, the service has been pretty poor from a Schwab perspective, and we're hearing it from you guys. And unfortunately, there's not that much we can do. And of course, we had no say in the matter. Because Schwab purchased TD Ameritrade when they went to 0% commissions, and TD just couldn't make it. Schwab kind of went in. We could always move our clients back to Pershing that we used to clear through. We could move to Fidelity. There aren't that many custodians. There's Interactive Brokers. Really, from a retail standpoint, though, the two biggest are now, Fidelity and Schwab. And they have kind of an oligopoly. They know that they kind of have us, where we're never going to pool all of our assets together and be a hedge fund, because then your assets aren't as safe, right? Your assets are much safer at Schwab, because all you do is give us the ability to buy and sell in your account. Your assets are in your name. They're protected. It takes us a lot more work, because when we're buying something, we're buying, let's say, $1 million of Goodyear tire, and we're putting $2,000 in my portfolio, $2,000 in your portfolio, Smitty, and $2,000 in Joe's account and everybody else's account. And it's a lot more work for us to do that, rather than just pooling all of our money together. But your money is not as safe as if I just pooled all of your assets together and put it all at Bank of America and did one audit per year. So I'm not a fan of hedge funds for our clients' safety. So we're forced to have a custodian. And Schwab's probably the devil we know right now. So I don't suspect that we'll move to and recommend that we move to Fidelity, but we're pushing them to try to improve their services. So I'd say if I was giving a grade, I'd probably give them a C minus for the transition. So we're probably as frustrated as you are with the transition, but we don't have many choices, unfortunately. It's kind of like flying on an airline. You know, if you're flying out of certain cities, you either got Delta and American, maybe you got a third to choose from, but you usually don't have that many choices. And it's the same thing with custodians.
That was really helpful. Thanks.
Thanks, Smitty. That was a really good question. Any other questions out there? It's my daughter Elena walking behind us. She's got to get to bed soon. It's sad not having all the kids in the house anymore. 3 of them are gone. Hannah's working for me. She's working now with the company after working at Bloomberg in New York City. And Maximus is in his senior year at Bowdoin, and Augustus is his freshman down at Purdue. And all the kids are gone except for one. But luckily, I got Elena for 6 more years. So
That's great, man. Talking about that Maximus, Jack deployed yesterday or last week, rather. He's on his UDP to Okinawa. So thankfully he went west and not east, right?
That is good. Yeah, that's a better way to go right now. That's what you were. Thank you for his service. And it's Augustus is actually trying to transfer to the Naval Academy. I just put in his application, and he just sent it to me, and we sent it to the congressman. So he's looking to transfer. So maybe he'll get in the Navy next year. We'll see. He's studying engineering at Purdue and doing ROTC. So
yeah, I meant to say
do.
Yeah, good luck to him if I can help.
Thank you. He wants to be a Marine like Gus Smith, even though I keep telling him go in the Air Force. It's an easier life than we had. And you spent a career in this, so you were much more glutton for punishment than I was in my only 8 years. So
that apple doesn't fall far from the tree, man.
Any other questions out there? Things that are on people's
minds? Can I comment?
Yes,
Is it
please.
working now?
Yeah, I can hear you.
Yeah, Mrs. Hey, what is the war that's moving over in the east now? What's that going to do to U.S. companies and about refurbishing all the arms and stuff we got going on?
It's been great for our defense companies that we own. And that's kind of a knee-jerk reaction. So the Lockheeds and Raytheons and their stock prices have exploded, which is sort of the typical knee-jerk reaction. People act as if, oh, we don't need we during the Obama administration, people were acting as if, well, we're never going to go to war because the Democrats have power. And I bought Lockheed and Raytheon and Northrop at 6 to 7 times earnings with 6% dividend yields. And you and I made, and you've been with us for 20 years, and you and I made 180, 160, and 140% in those defense stocks when we bought them. And then subsequently we sold them, and now we're in defense companies again because they were cheap. Now they're getting a bit pricey again. So we're kind of seeing, the typical knee-jerk reaction that they're going to have to, they have to replace all of those rockets that they're firing and tanks that they're losing. And of course, we're fighting a proxy war for Ukraine and supplying them. And now we're going to do the same thing with Israel, likely with a lot of the rockets, and which is why the Biden administration is asking Congress for more money to be able to do that. So that'll certainly help the profits of those companies, and that'll help us as shareholders of those companies too. So sometimes war can be a positive for some companies, and a negative for others. And that's why you want to own, kind of like you see here in this picture for our balanced portfolio, that we own 23% is in bonds, and we own healthcare companies because people still probably use healthcare. We own industrials, which are more cyclical, like your 3Ms and or a Stellantis, right? So people are worried about, one of the questions I had this week was from a GM executive who's been a client for 20 years. And he said, I don't know. He actually wrote Mary Barra a note and said, go offshore. The unions are killing the companies. I would say, yeah. Now we own Stellantis, which owns Jeep, Dodge, Chrysler, but also owns, Maserati and other auto companies. But a little less than 50% comes from the U.S., but it's already an offshore company. and they may pull more plants out, right? And the unions know that too. They don't have as much leverage with Stellantis as they do, say, General Motors and Ford. And Elon Musk is right that the unions could bankrupt these companies. A certain thing, we had GM go bankrupt, of course, without a bailout. Ford kind of hung in there without a bailout. And so that these industries are cyclical. Like Toyota, obviously not as impacted by the United Oil strike. Financials are cyclical. Consumer staples like Nestle and Pepsi, not as cyclical. Energy is much more cyclical, and you kind of want to own all the above, and that's what we're doing here. Is we own some of those industrial companies, that are like the defense contractors, and then we own financial companies like J.P. Morgan and U.S. Bank and Citigroup and Royal Bank of Canada, Bank of America, BNP Paribas, and then telecom today. Verizon was up huge, up 9%. A company we own just because they had good earnings. And then again, we own healthcare companies, which tend to be more stable. These are global companies. Sometimes people don't know Total as much but if you're living in Europe, you would know Total as well and probably better than you would know Exxon. Companies like Caterpillar that we own, Eaton really is an Ohio company, but they just like people who live in New Jersey and say, hey, you're taxing me too much. I'm moving to Florida. Eaton did the same thing. Hey, we're really an American company, but most of our profits are coming from overseas. So we're leaving America and we're going to Switzerland or we're going to Ireland. And that's what companies do too. They move for tax reasons. Of course, we own General Dynamics, which is a defense contractor. We own Lockheed, and we own Raytheon, which was up a lot the other day. So I think that you'll see this yin and yang of companies doing well and not so well, based upon whether we're going into a recession or coming out of one. And that's why you want to own different sectors of the economy. And regardless, again, 80% of our companies increase their dividends over the last year. So, people keep smoking, they keep drinking Pepsi, using Procter and Gamble and British Tobacco we own, Nestle and Philip Morris, Kraft Heinz, still eating cheese, still eating ketchup.
Keep doing what you're doing because we're spending money here.
Well, that's what it's there for. We can't take it with us. So that's what those dividends are for. Spend it.
She's not in here with me now. I'm not going to tell her that.
I think we men sometimes spend more than, I know Annie accuses me of that too. Like sometimes women will buy more of the little stuff, but then we men go out and buy big stuff like cars or airplanes. I started flying a couple of years ago again. Airplanes are pretty expensive. So I can't never blame Annie. It's usually me who's spending more money when it comes to big ticket items. That's why I'll work till I'm dead. I've been doing this 27 years. I hope to do it at least another 30 years. Let's see, that puts me at about 84. I don't plan on retiring at 84. I hope I will keep going, God willing, as long as my head's still working.
Well, keep at it. Keep at it.
I'll keep trying. Any other questions out there? Oh, I guess we covered everything then. All right, we solved all the world's problems. So. All right, well, thanks for joining. If you do have other questions, as always, just shoot us an email. Obviously, your specific circumstances are always very unique, and we're happy to to answer any of those in relation to your own specific, and use that e-money and work with your lead advisor on the planning side, and I'll keep spending my time analyzing, and as Anu and Chris do, and Zach. And actually, I'll show you the one team page. So sometimes people wonder who does what, at our firm. And if you look at our team page now, we got a lot of associates, some of which you don't mean. So Zach's been with me for, 13, 14 years, and he's our lead PM. He's making the final decision on your fixed income portfolio. He thinks just like I do in terms of, what we can buy, and trust him 100% to make those decisions. Anu's running our international portfolio now, final decision maker, international portfolio. Again, good good value investor like me, and I still make the decisions on the U.S. stocks, and then I make the final decision on our allocation too for our portfolios as the chief investment strategist. And then Greg and Chris and Max and Harrison are on the advisor side. Becky and Hannah are always doing the trading in your portfolio. So when you see a stock bought or sold, or a bond bought or sold, that's usually Becky or Hannah doing that. In addition to, Joy will sometimes get involved on the trading side, but then all the back operations stuff in terms of what you need, that's Rita, Claudia, and Joy doing all of that. And we're actually in the process of probably hiring another operations person to assist also. So we keep growing as a firm. On the advisor side, for the private client side, we're set up so that Harrison and Greg and Chris and Max, Max is a CFP, Harrison's working on a CFP, Greg's a JD with a lot of expertise in real estate. If you have real estate questions and needs, he comes from that background. And of course, Chris is a CFA, and on the planning side, we usually can get you an answer from one of our experts in something that's involving on the planning side. And again, on the investment team, that's Zach Anu, me, Becky, and Hannah, and then our ops team. So that's some people you haven't met. You may, when you call in, maybe you talk to Claudia or Joy. A lot of you have known Rita for past 20 years. I'm not letting her retire ever. So hopefully she'll just keep working forever. And then Annie, my wife, just left us she still hasn't left me personally yet, which is nice. But she's just got burned out after 18 years working at Altrius, and decided to work with a different wealth management firm where she can drop the pack and work 9 to 5 and not have to work kind of hours that I work, 70, 80 hours a week. So Annie's, I sent out that email. Annie left us in August, I think.
Well, thanks, Jim. Appreciate your time. Have a good evening.
You too, Lou. Thanks for joining. Tell Anne I said hi.
I surely will.
Thanks, Jeff. Thanks for calling in too. I see Jeff's leaving. So thanks everybody for joining tonight. Questions, if you have any others, just send us an email or whatever you need. So take care, everybody, and good night.
All right. Good night.
Thank you. Good night. All the best.